Welcome to today's video, where we unpack an overlooked risk to your future mortgage: unused buy now, pay later accounts. We'll demystify how even a simple BNPL registration can create data trails, trigger soft inquiries, and raise underwriter concerns about your potential debt exposure. We will also share practical steps to clean up your financial profile before a major loan application. First, let's set the stage with what we'll cover and why it matters. Here's our plan. We'll start with a quick refresher on BNPL and the invisible data footprints. Next, we'll connect the dots to mortgage underwriting and explain why an unused BNPL account can still raise eyebrows. Then, we'll focus on the core risk, your revolving capacity, and the uncertainty it introduces for debt-to-income calculations. After that, we'll share a cleanup playbook you can apply before a mortgage pre-approval. We'll also visualize the data flow and your preparation timeline. Finally, we'll test your knowledge with a short quiz. With that, let's begin with an important disclaimer. This video is for educational purposes only. It is not legal, tax, or financial advice. Credit reporting, data sharing, and underwriting practices vary across lenders, BNPL providers, and jurisdictions. Additionally, closing or altering credit lines may influence your credit profile in ways that differ by person and by scoring model. You should consult a licensed mortgage professional or financial advisor for guidance tailored to your situation. Now, with that clarity in place, let's define what BNPL is and how its data can surface during underwriting. Buy now, pay later services let you split purchases into short-term installments. Even creating an account, sometimes without linking a card or making a purchase, can trigger a soft inquiry. While soft inquiries typically don't reduce your score, they can still appear to underwriters or via data aggregators. When you accept or bypass the privacy policy, you may be consenting to broader data sharing with affiliates and third parties. Underwriters evaluate more than a score. They analyze your account mix, payment behavior, and potential exposure to new debt. The pie chart illustrates that score is only one part of the underwriting focus. Income and debt-to-income ratios, account behavior, and reserves all matter. Next, let's visualize how your BNPL signup can ripple through the data ecosystem. This flowchart maps the journey from your BNPL signup to the underwriter's desk. First, your signup information goes to the BNPL provider. Then, a soft inquiry may be issued to a credit bureau or alternative data source. Next, this data can be shared with brokers or analytics platforms that aggregate consumer credit information. From there, your lender's underwriting system ingests the data and presents it to a human underwriter. At that stage, open BNPL lines, even with zero balance, may be flagged as potential future debt, alongside patterns like short-term credit dependence or multiple BNPL accounts. Those flags can lead to requests for additional documentation, delays in approval, or more conservative loan terms. Importantly, the diagram also shows that closing unused accounts prior to applying can reduce flagging. Now that we've seen the data journey, let's detail the specific risk underwriters watch for. Underwriters treat an open, unused BNPL account as available capacity to incur debt at any time. Because you could quickly accumulate obligations, it injects uncertainty into your future debt-to-income ratio. Additionally, multiple short-term credit arrangements can appear as fragmented borrowing behavior, which some lenders interpret as instability. Even if you only registered and never transacted, that action can create a data trail. In tight underwriting environments, uncertainty and perceived risk often lead to delays, additional scrutiny, or less favorable loan terms. Next, we will compare how BNPL lines and traditional credit cards are viewed through an underwriting lens. From an underwriting perspective, BNPL accounts often present less predictability. Reporting practices vary, and the installment cadence can be irregular. Open BNPL lines, even unused, may be treated as potential new obligations. By contrast, credit cards have long-established reporting norms, clear limits and utilization calculations, and predictable monthly cycles, which makes risk assessment more straightforward. Consequently, while both are forms of revolving or short-term credit, underwriters generally find traditional credit card profiles easier to model. With this comparison in mind, let's move to practical steps you can take before a mortgage application. Here's your cleanup plan before seeking pre-approval. First, list every open credit line, including BNPL accounts. Second, review privacy policies and opt out of data sharing wherever that option exists. Third, close unused BNPL and dormant credit lines, and make sure you receive written confirmations of closure. Fourth, Avoid opening any new accounts during the 3 to 6 months leading up to your mortgage application to reduce financial noise. 5th, demonstrate stability through consistent income deposits, on-time payments, and steady balances. 6th, save all closure confirmations and screenshots in a dedicated mortgage folder to provide proof if requested. 7th, monitor your reports to see whether soft inquiries and open lines are reflected and to ensure closures are recorded. Next, let's visualize a timeline for these actions so you can plan backward from your target application date. This timeline starts 6 months out. At -6 months, audit all credit lines and begin closing unused BNPL accounts. At 5 months, confirm closures in writing and opt out of data sharing where available. At 4 months, focus on stabilizing your cash flow and avoid opening new credit. At 3 months, verify your reports, reflect closures, and keep balances steady. At 2 months, assemble documentation like pay stubs and bank statements. At 1 month, ensure there are no new inquiries and keep activity quiet. On application day, submit a clean, well-documented pre-approval package that highlights stability. Now, to make execution even easier, here is a concise, markdown-style checklist you can follow. Use this checklist to track your progress. First, list all BNPL and revolving lines and mark any unused accounts. Next, review privacy policies and opt out of data sharing if the provider allows it. Then, initiate closures for unused accounts and save all confirmations. Show stability by maintaining consistent deposits, avoiding new credit for at least 3 to 6 months, and keeping balances predictable. Finally, centralize your documents in a dedicated mortgage folder and monitor your reports to confirm that closures are reflected accurately. With your checklist in hand, let's look at a simple playbook for closing BNPL accounts efficiently. This playbook breaks closure into 5 steps. Locate the account settings or help center and capture a screenshot showing where closure options are found. Next, submit a closure request and explicitly ask for full account closure, not just uninstalling the app. Confirm that your balance is 0 and that no installments are pending. Wait for final settlement if needed. Document everything by saving confirmations to your mortgage folder with consistent file names. Finally, verify your reports within 30 to 60 days and follow up with the provider if the account still appears open. Now let's lock in your understanding with a quick quiz. Question: which action most effectively reduces underwriting uncertainty from BNPL accounts before a mortgage application? Options: A. Uninstall the BNPL app and do nothing else. B. Make a small BNPL purchase and pay it off quickly. Formally close unused BNPL accounts and retain written confirmation. D. Apply for more credit cards to improve utilization. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is C. Formally closing unused BNPL accounts removes the available capacity that underwriters view as potential future debt. Retaining written confirmation allows you to document the closure during underwriting, reducing questions and potential delays. Making a small purchase and paying it off might still leave the line open. Uninstalling a loan does not close the account. Applying for more credit cards could introduce new inquiries and additional complexity. Now let's try a second question about soft inquiries. Question: true or false? Soft inquiries never show up to underwriters and have zero impact on mortgage decisions. Options: A. True. B. False. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is B. False. While soft inquiries usually don't impact your score, they may be visible to underwriters via certain reports or data sources. That visibility can shape how an underwriter assesses your behavior and potential exposure to new debt. Next, let's recap the key takeaways so you can move forward confidently. Here are the key points. First, unused BNPL accounts can be viewed as revolving capacity and potential future debt. Second, soft inquiries usually don't lower your score directly, but can be visible to underwriters. Third, reduce financial noise for 3 to 6 months before applying by avoiding new credit. Fourth, close unused lines and keep written proof. Confirm that your reports reflect the closures. Fifth, demonstrate stability through consistent income, on-time payments, and steady balances. To bring everything together, let's summarize the full story in one place. In summary, Even a simple BNPL signup can leave a data trail that becomes relevant during underwriting. Open, unused BNPL lines introduce uncertainty around your future debt-to-income ratio and financial discipline. To mitigate this, proactively close unused accounts, opt out of data sharing when possible, and keep thorough documentation. Follow the 6-month preparation timeline to reduce financial noise and present a stable, predictable profile to your lender. Finally, remember to consult a qualified professional for advice tailored to your local regulations and personal situation. To close us out, here's a quick thank you and a request. Thank you for spending time with us today. If you found this useful, please like the video, share it with someone planning a home purchase, and subscribe for more deep dives into credit and underwriting. We would love to hear your experiences. Tell us in the comments how you're preparing your financial profile and what topics you want next.